Several weeks ago, I put out a video that showed how the price of gold increased in relation to the currency in circulation as well as the M1 money supply. I also showed how this could generate a real return for the holders of gold because efficiency gains in society and the increasing population results in price increases of commodities as well as goods and services not climbing as rapidly as the rate of the increase in the money supply. I won't rehash that video, but I would encourage viewers to go back and review it in case they don't recall the specifics. Today I would like to expand that analysis to include a broad measure of publicly traded stocks, the S&P 500 index. I'm doing this because I think it's important to draw a parallel between the major source of stock market returns and the source of gold's returns. I'm probably going to ruin the rest of the video for you by telling you this, but the source is one and the same. Take a look at this chart. Pause the video if you need to. What you will notice is that just as gold's price has increased alongside the expanding money supply, so has the S&P 500 index. One thing I would like to make abundantly clear from the start is that I am not including reinvesting dividends for the stocks. This is just the raw nominal price level of the index. I'm doing this to explain the source of capital gains, and will add in dividends later. Take a look at how the S&P 500 tracks very closely the amount of currency in circulation. Is this happenstance correlation? I'd argue no. Also, compare the price level of the S&P against gold, which is plotted on the right-hand axis. The scales are the same in terms of the axis gradation, and so a person can see that they both rose, albeit in different price patterns, to mimic what was happening to the money supply. Let me show you a summary of overall price increases so that you can see what I mean. Here is a similar table to what I showed in my video from a few weeks ago. I'm showing the starting and ending values for several monetary measures, gold, the CPI, gross domestic product, and the continuous commodity index from 1971 through 2018. I have added the S&P 500 to the table to illustrate that it has also changed in a similar fashion to measures of money supply. Currency in circulation rose by a factor of 28.6. The gold price is up by a factor of 30.8. The S&P 500 is up by a factor of 28.0. Annualized, these are rates of increase of 7.3%, 7.5%, and 7.3% per year respectively. Is this a coincidence? I'll leave that up to you to decide over the next few illustrations. First, I will show a correlation relating nominal gold price increases as a function of the amount of treasury gold covering the currency supply. Just to avoid confusion, I should make it clear that I am using currency in circulation this time in my correlation, whereas in my previous video, I used the M1 money supply. Gold appears to have a much cleaner correlation against M1, but for the sake of comparison against stocks, I will use currency in circulation instead because you will see that the S&P 500 index correlates very closely with currency in circulation. Here is a graph over the past few decades showing the ratio of currency in circulation to the marked-to-market value of treasury gold. It varies over a fairly wide range, unlike the ratio with M1, which tends to move towards a central value. However, it can be seen that there is still a tendency of the ratio to vary around a central value. In this case, the central value is 3.78. At times when the ratio approached 1, as it did in 1980, the gold collateral, held in the form of gold certificates, would be amply valued to return the United States to a 100% gold-backed monetary system if the monetary authorities chose to do so. This represents a point where the currency itself could be considered cheap. 1980 was a good time to exchange gold for currency and invest in highly yielding debt instruments. We can see from the graph that in 2001, the amount of currency exceeded the market value of treasury gold by almost a factor of 9. And this marked the peak in confidence in U.S. currency. This was a good time to avoid the currency and store wealth in gold instead. Over the subsequent 10 years, confidence in the currency waned, and a point was reached in 2011 when the currency was somewhat undervalued relative to gold. Conditions were not as extreme as they were in the year 1980, but still, signs were pointing to the fact that gold was not nearly as undervalued as it was in 2001. Using this information, we can develop a correlation for 10-year gold price changes as a function of currency in circulation relative to Treasury gold. It's not as clean as the one that I developed using M1, but it will still be illustrative. And here it is. Even though the correlation is not very tight, we can still see the relationship. When currency in circulation divided by the Treasury gold is at its equilibrium value of 3.78, we can expect the price of gold to rise at the same rate as the expansion of the currency, which has been 7.3% per year on average. When currency relative to Treasury gold is much higher than its equilibrium value, then we can expect gold to strengthen in the currency, which is the same thing as saying that the currency will weaken in gold. So where are we now? Let's take a look. Treasury gold currently has a marked-to-market value of $348 billion. The currency in circulation is $1.7 trillion. This leads to a ratio of 4.91. In other words, gold collateral only covers about 20% of the currency in circulation. The difference between the ratio and the equilibrium ratio of 3.78 is 1.13. Going forward, this would suggest that gold should have a slight upward bias in price increase relative to the currency supply. It should increase in price by about 2.8% more per year than the 7.3% rate of increase in the currency supply, or about 10.1% per year. As I always warn though, this is not a prediction of what will happen this year or next. This is a decade-long price prediction. Let's do the same exercise for stocks and see what the relationship looks like. I think you'll be surprised. Here is a plot of the ratio of the S&P 500 to the currency supply in billions of dollars. As I showed earlier, the index tracks the money supply fairly closely, and so it should not be a surprise that the ratio does not tend to stray very far away from a central value. The equilibrium value that I show here is 1.39. There have been times when the ratio was quite a bit lower than 1.39, such as in 1980 and again in 2009. Both were good times to buy stocks. As can be seen, capital gains over the following couple of decades were quite good. On the other end of the spectrum, we can see that when the ratio was significantly above 1.39, such as in the year 2000, subsequent capital gains were lower than normal. This is not to say that capital gains in the S&P 500 were negative. Remember, the Federal Reserve has been increasing currency in circulation by a fairly consistent 7.3% per year. At that rate, it doesn't take long for any increase in the currency supply to make up for overvalued levels of the S&P 500. And there's the real secret to the stock market. With such a rapid rate of growth in the money supply, it doesn't take long for inflation to make up for stupidly high valuations. Stocks for the long run indeed, Professor Siegel. So let's construct a model of capital gains similar to what we could do for gold and see what happens. Here I show all of the calculated 10-year nominal index returns plotted against the ratio of S&P 500 price to currency in circulation. You can see that the relationship is really quite good. The line is sloped in the other direction from that of the gold chart because, in this case, I made the S&P the numerator rather than the denominator. As was the case with gold, when the price of the S&P 500 climbs more quickly than the 7.3% rate of growth in the currency supply, it tends to drag the ratio to higher levels. This puts downward pressure on the S&P 500 price until a point is reached when the currency creation can catch up. Conversely, when lots of currency is created but the S&P 500 lags behind, it puts some upward pressure on the S&P 500 price, and so future capital gains rates should play catch-up. Over the long term, however, gains tend to match the long-term rate of currency inflation. Let's see where we stand now and predict where we may be going. With the S&P currently standing at a level of 2793, its ratio to the currency supply measured in billions is 1.63. Historically, the ratio has varied around a central value of 1.39, So right now the S&P is a little higher than where it should be relative to the currency creation. As a consequence, we should expect some slower capital gains going forward. How much slower? We should expect capital gains to be about 2.25 points lower than normal over the coming decade. Horrible? Hardly. Add that to the 7.3% per year rate of expected currency printing, and then tack on a modest dividend yield, and we can expect a nominal return of slightly shy of 7%. But think about this for a minute. What is really happening? Is this nominal return coming from the brilliance of corporate executives? No. Is it coming from the tremendous cash flow being paid out as dividends? Again, no. All that is happening is that the level of the market is tracking currency creation. The increase in nominal values is really just a reflection of currency destruction. So gold and stocks share a common trait. They are both a means of escaping the destruction of fiat currency. They both also appear to have the benefit of allowing productivity gains to flow through to their owners. For these purposes, both gold and stocks work, though gold doesn't have an army of executives demanding exorbitant compensation for providing this service. The past 8 years have been a challenging time for gold purchasers. 2011 was a high level of the gold price and a low level for stocks. As a consequence, we saw stocks perform better than gold. It didn't have to pan out that way, but the math said that the odds favored stocks. Going forward, we may see the advantages tip towards gold. The odds would seem to favor that right now. One thing that we can know for sure is that over the very long term, both gold and stocks will increase in price as the dollar is debauched. All you need to convince yourself of this is to stare long and hard at this chart.